Good afternoon. My name is Jonas Richter. I'm the student ambassador of PEFM, and I'm going to introduce Christopher Marsh, who's going to give a talk today on the monetary history of the euro area. Christopher did his economics degree in Cambridge, followed by a PhD in Warwick, and he joined then the IMF in 2005, where he mostly worked in the policy department. In 2012, he returned to London and worked mostly in the finance sector since. He's currently blogging as the General Theorist and is consulting for macro hedge funds. And yes, the talk will be on record and the Q&A session will be following the Chapman House rules. Perfect, I will hand over to you.
Thank you. So just to be clear, that's not me on there. That's my blog icon for some reason, for reasons you may find compelling in a moment. So what I'm going to do today, I've bitten off way more than I can chew, which is probably the fatal mistake when giving a presentation. But what I want to do is try and walk through some way of thinking about the macroeconomy that has gone a little bit stale in recent years, that I believe is useful and at least provides some insights into the challenges that we faced in Europe, and with that in mind, may set the stage for thinking about how the challenges of Europe can be solved. So, of course, kind of the motivation for this is the Friedman and Schwartz monograph on the monetary history of the United States. And, of course, it's difficult not to find certain parallels between the situation in the United States in the interwar period and more recent challenges in Europe, not least, about sort of a new or fledgling central bank running a monetary policy for a large potential currency area with limited fiscal space and with a banking system that's kind of fragmented. So I'm going to try and begin by introducing the Friedman and Schwartz way of thinking, or at least outlining that, and then go on to having a look at how the crises in recent years have played out, beginning in the Baltics, looking at the Greece situation, and then looking at the euro area more generally, and sort of pointing at how the thinking about this challenge hasn't really lived up to what I think was the sort of historical way of thinking about challenges of the open economy. So I think some running themes, and these are the takeaways from this. The first one is, I think there's a lot of things that have been said about the crisis that need not stand up to scrutiny in terms of telling the absolute truth about what's been going on. So, as always, we can invoke Orwell for this. I think this was in 1984, where he's in room 101 and his interlocutor points out that whatever happens in our minds truly happens. If we control the message, then that's what people will believe. But I think sometimes the message has not really been as clear as it could have been. A second theme that runs throughout this is the primacy of finance and politics over macroeconomics. Now, these are sort of familiar themes to all of us, but one thing that strikes me in particular is two ways that I think the primacy of finance is manifest. The first one, thinking about Kindleberger, when he wrote the history of finance of Western Europe. At the beginning of that book, he goes through different ways of thinking about finance in terms of the macroeconomy. One way is that the finance just adjusts to the needs of the real economy and it's kind of a passive agent. The other one is that finance is a driving force, is one of the key factors that drives macroeconomic outcomes. And now my view, having witnessed the crisis up close, is that finance is truly one of the key driving forces, in the sense that behaviour of and decisions by the financial sector are key to driving macro outcomes. And the traditional way of thinking about macroeconomics kind of plays it down substantially. The idea that the Modigliani-Miller theorem may hold in our models of, in the models pre-GFC, means that finance plays a very limited role. But I'm going to try and argue today that it's crucial. And of course, politics as well. Politics is key in driving the decisions that have been taken. And so on top of this, there's a sense in which macroeconomics, in the traditional sense, has been betrayed. We have Hume's on balance of trade, Henry Thornton through Keynes, Hicks, Jacques Pollock at the IMF, Milton Friedman, of course, Schwartz, but also more recently there are people like Richard Koo at Nomura, who has his way of thinking about the Japanese experience. and Ray Dalio, one of the biggest investors in the world, has his views about how cash flows throughout the economy. These are all important ways of thinking about the macroeconomy that sometimes play a backward role in the way that macroeconomics is actually done. Related to all this is that the balance of payments, money and the macroeconomy are intimately linked. So I'm referencing here the monetary approach to the balance of payments, with in particular thinking of again back to Hume, this idea that the price species flow mechanism, the links between financial flows and macroeconomic outcomes. This, of course, plays a role in Harry Johnson's thinking at Chicago. Jack Pollock again, and also Michael Musser, who was at Chicago in the IMF, all used to think about monetary outcomes and the balance of payments in conjunction with each other. But again, this is not the way that we do macroeconomics these days. And of course, the final one is that institutions and individuals matter. So outcomes depend on institutional frameworks and institutional strengths. And if they are lacking, then the outcomes can be worse than they ought to be. So they're the key themes. So I want to start with a little bit of the monetary history of the United States, although I can't confess to being an expert on this, and I'm sure there's at least one person in the room who would know this far better than I do. But looking at the key points in US history when sort of decisions on money and finance were taken, was after independence. We had there was what's his name? The assumption of the debts of the was it 12 or 13 states in 1790, so that essentially at that point the issue of the federal the sort of centralization of the federal structure of US debt was resolved way before any of the more recent challenges. And at the same time, at that time, it was Alexander Hamilton who sort of instigated the first sort of central bank, first bank of the US. But there was always a tension between centralization of political and financial power and sort of the structure of the US and across different states. So that the first charter of the bank expired in 1811. It was instigated again after the war in 1812 to help finance the situation, but again that expired. So the US had kind of a centralized government debt market, but no central bank. And then you had a period of free banking and so forth until the Civil War and the National Banking Act. Now the key point here is that at that time, the US set up a unit banking system, which meant that you had a lot of banks that were essentially banks for one town or for one small town or for one small area. There wasn't a branch banking system. So that banks essentially didn't have if deposits moved around, they were in big trouble. So you had this unit banking system that was embedded in the structure of the system. And after the panic of 1907, you then got the Federal Reserve Act, which then brought about the Federal Reserve, and then of course the Great Depression in 29 to 39, or roughly that stage. So this is the data from Friedman and Schwartz, which is essentially their visualization of some of the macro outcomes. It isn't the full set of data, but it's available on the NBR website. The key point here is the blue line, the broad money, and they try and interpret macro outcomes through the money supply. The grey bars are recessions that are of the recessions that have taken place over the period. So I'm focusing on all of their monthly data from 1907 when monthly data becomes available. And the key point, of course, is that you had these periods where the money supply was falling, and they're coincident with periods of economic contraction, falling prices, falling industrial production. And you also had this, so the red line is the currency held by the public, and you had periods where people would run out of bank deposits into high-powered money, and that would then cause the banking system to slow the economy. And it was exactly this challenge that the Fed was intended to prevent. So that was this is the sort of aggregate way of thinking of Friedman and Schwartz. There's another way of thinking which was by Lester Chandler, who's also written a lot about the US history of money. And this is from his American Monetary Policy book. And he looks geographically across the different Federal Reserve banks to ask what was the behavior of the money stock across those different areas of the macroeconomy. And the key point here is that at the beginning of the Great Depression, or in 1930-31-ish, the deposits of New York member banks actually rose. Because essentially what was happening is that the Depression hit the smaller towns and these unit banks, these country banks who were transferring money back to the centre to pay for their debts and because their terms of trade adjusted. And so you had this, it's sort of an internal balance of payments challenge of different parts of the economy. So that was the beginning of the crisis anyway. So you can see New York member banks and other medium banks in Chicago, they actually increased their deposits initially and they only fell later. And so Chandler's quote here is a major reason is because shifts of deposits and reserves away from country areas, these reflecting in large part unfavourable balance of payments of agricultural areas. And then, you know, that basically this unfavourable balance of payments reflected both the income account and the capital account. So on the one hand, they had a terms of trade shock because prices were falling of agricultural products, and on the other hand, they were asked to repay some of the debts they owed to insurance companies and distant creditors. So there was a sort of a geographical angle to this Great Depression story. This is also from Chandler, which I'll go through it pretty quick. Essentially, these are the country banks, in particular at the 12 Federal Reserve banks at that time. Again, this is in Chandler, and essentially all of the country areas suffered much worse drawdown or reductions in their money stock than the central than the government than the system as a whole. So essentially, you've got transfer of deposits from certain geographical areas to others, and of course, this kind of brings us into Europe, where one of the striking features of the euro area crisis, so the black line here is the money stock of the euro area as a whole, and it's normalised to 100 or to 1, sorry, in the beginning of 2001. And the money stock as a whole, you can see it sort of reached a peak around 2010, and then there's a sort of a transition where it slows and then eventually picks up again. But you can see that the behaviour across different countries is very, very different in terms of the run-up before the crisis and since. So there's a geographical angle to the euro area crisis in the same way as the US suffered in the Great Depression. So I'm going to begin by giving you a little bit of a story about how the crisis had unfolded in the Baltics. And the reason this is interesting is at least because it was a kind of a natural experiment for what would happen across the periphery afterwards. It also brought together, and it's a natural macro experiment, so it helped understand what would happen later. It also brought together the Troika institutions as well as the Nordics in this game of international cooperation, and then the issues of like, how is this going to play out. And of course, one of the challenges here is that the IMF has this long history of macroeconomics, going back to the immediate post-war period. But the problem is, after the Asia crisis, so my thesis runs, that was dropped a little bit. So, for example, after Bretton Woods, where the IMF was charged with lending in Article 1, I think it's 7 or something, lending on a temporary basis without resorting to measures destructive of national or international prosperity. And then this guy Jack Pollock, who was at the Bretton Woods conference representing the Netherlands, I think he was a mission chief in the IMF, and in the early days of the IMF, no one knew how to implement this idea of providing adequate safeguards for IMF lending. But he went to Mexico, and under the influence of Ragnar Nursky, I think, he came up with this, thinking about the monetary sector as the fulcrum around which the economy will function. And so he began to develop this financial programming framework. Essentially, we could think about the economy in terms of the monetary sector, the fiscal sector, the balance of payments. You fold them all together, and you would get a sort of a way of thinking about how the macroeconomy evolves. And central to that was credit of the banking system. The banking system creates the money through the asset side of the banking system that generates income and then savings. So it's kind of like, it goes back to Keynes's thinking in 37 as well. So by 77, the IMF had instituted this in the monetary approach to the balance of payment. At that, in a book published in 1977 by the IMF, there was a book of the same exact name published at the University of Chicago by Harry Johnson and his friends, and they're essentially doing a similar thing, saying, look, you have to think about the balance of payments as a monetary phenomenon. It is the reflection of the aggregate portfolio choices of the economy, which are reflected in the balance of payments. So this became sort of like the institutional framework for doing lending arrangements at the IMF. But then it came the Asia crisis and the Argentina crisis, in particular in the late 90s. And one of the things about the Asia crisis was, because it was no longer a traditional IMF program, which was basically because the government was borrowing too much from the banking system, losing international reserves. Instead, it was foreigners withdrawing credits to the economy. So it was kind of flipped the situation facing member states. Nevertheless, the framework itself still holds, but what happened at the IMF is essentially the framework became outdated and people started to stop using it. And this was despite the fact that, in a way, the Eurozone as a whole was moving into a single currency which would require some analytical framework for understanding macro outcomes. So in 1999, the euro was born, and about a decade later, the global financial crisis. I'm going to skip the financial programming analytics, but except to note that it's a bit like a crossword puzzle where each sector of the economy represents a different word, and the crossword puzzle requires you to put together all the different words. And if you have interlocking letters in the crossword, you have to know you have to make sure that the letters are common to the two words to know you've solved the puzzle. So it's kind of like a crossword puzzle in which you have different sectors doing different things, but you have to make sure all the financial flows add up. Now, turns out that
just tell us what the two lines on that are.
Oh, okay. So this is essentially the monetary accounts is the going to the right, the balance of payments, the BP going down to the right.
What's the meaning of those two lines?
So, if you think of this in the traditional world where you just have a central bank which is accumulating foreign exchange reserves, so delta R. So a central bank will accumulate foreign exchange reserves if, for example, on the balance of payments relation, suppose you have more exports. So if you're exporting more than you're importing, so if you have a current account surplus, then you will be running a current account surplus, and you'll accumulate foreign exchange through delta R. But if GDP Y is higher, so going to the right with the BP curve, GDP is higher, then you're going to import more. And if you import more, then your saving investment balance is going to tip against you, and you may end up with delta R being negative.
Yeah,
so that's
sorry.
Yeah.
David's question. MM, it obviously stands for money, I think.
Yes.
Which money?
Uh,
I mean, you're swinging between balance payments, which is most of
Yes.
financial assets,
Yes.
and high-powered money. I'm deeply confused which one you're talking about.
Okay. Well, you can do it in either way, but I'm thinking mainly in terms
I
of.
don't think you can.
I think it's just a question of how you specify the relationships between base and broad money.
The question they were.
Okay.
Yeah.
Well, the way I'm thinking about this, MM is broad money, but it could be high-powered money. But the issue is, if there's a stable relationship between base and broad money, then there's much of a muchness.
Yes, but there isn't.
Okay. Well, there may not be, but that's part of the challenge, right?
I asked the Central Bank of China Research Department what the relationship between those two things was, and they just done all the Pollack thing, all out for everybody to see. And they said, well, of course, they don't correlate at all. That's China.
Yeah, but China's a kind of a particularly strange story as well, because I think they have their own internal flows going on, different regions getting different amounts of paper. But
I mean, you're swinging, as far as I'm concerned, between the total flows, sort of coup type analysis,
yeah,
and a monetary framework, which usually starts with monetary base. And there's a huge range of different possibilities between them.
well, yeah, and I wouldn't want to argue about what is the correct definition of money, but yeah, okay. So let's take a a really simple small open economy. Then ideally, there's a very close link between base money and the reserves, changing reserves. So yeah, I agree with you. That's the simplest form. But here, if you think of delta R and broad money being somehow related, like there's a money demand for broad money for the economy as a whole, then you can write it in different ways. But I mean, the point here anyway is that if you extend domestic credit, which is MM shifting down here, so you're creating loans, you're creating demand in the economy, you're pushing MM down, and you're lowering the amount of reserves you can accumulate given the balance of payment situation. Now the two are closely linked, so you can't just look at one on its own. But that's the issue that Pollack was insisting on. That look, you need to look at them both in conjunction with each other. So here we have. I'm not going to go through them all, but let's choose one on the right. So Pollack. So basically, the way that he said, look, this is how we should do it. So you have all these sectors, you make sure they're internally consistent, and you engage in this iterative calculation to make sure that you have a sense of what are the macroeconomic outcomes when you're looking to achieve a particular program objective. And the key point here as well is that in the Chicago approach, they assumed basically they criticised Chicago and Harry Johnson because they're saying, look, they just assume that you have an inflation rate and a real GDP growth. They just take it as given, and then they calculate the demand for money and therefore the balance of payments through the monetary accounts exclusively. Pollack comes along and says, look, you can't do that. You need to look carefully at the balance of payments and the monetary sector in conjunction with each other, and you need to iterate between the two to understand what the real macroeconomic outcome is going to be. This is the IMF approach. It's an iterative approach between the different sectors. There's some various quotes saying the same thing as Mundell, describing it as a general equilibrium technique. But the point is that when the Asia crisis arrived, this is in Paul Bluestein's book from 99 on The Chastening, the one about the Asia crisis, where someone says to him, look, you know, we used to have this way of thinking, but by the way, it's not clear that our theory works anymore. So there's this general sense of, look, you know, maybe this isn't the way of doing it, maybe it doesn't help in an EM crisis. So this is the one on the right here. So it's certainly not made for emerging market countries. Is this idea that the Pollack model was useful, but in the day, but you know, it's not useful now because we're not, you know, it doesn't work for emerging markets. The problem is that in fact it still provides a framework for thinking, right? So I'm going to do this pretty quickly. So Latvia's crisis is remarkable, as were the Baltics more generally, because essentially on the left you can see the assets of the banking system. And the banks basically were lending to households and non-financial corporates, and these are in billions of local currency. And you can see back in 2003, the loans to households and non-financial corporates were 2 or 3 billion lats, and they increased very rapidly to nearly 14 billion. And that was exactly coincident with an increase in foreign liabilities. So essentially, the banking system was borrowing from abroad in order to lend to the domestic economy. And now, in a traditional way of thinking, you wouldn't have the foreign liability, you wouldn't be able to borrow as much from abroad, and then you'd run up against the constraint of a fixed exchange rate, because they had a fixed exchange rate. So if you're expanding credit so rapidly, you would run up against, you know, your reserves of the central bank would be run down, etc. But because they could borrow from abroad with impunity, essentially they were able to sustain this lending massively. And when the crisis hit, they reduced foreign liabilities very sharply, which resulted in a contraction in domestic credit, which resulted in a huge contraction in output. So very quickly, I think the key bit here is the chart on the right. So foreign liabilities to broad money, the yellow line. Foreign liabilities to broad money were about 1.5 back in 2003. They increased to about 2 3/4 in 2008. So essentially, the banking system wasn't generating credit domestically for lending. They were borrowing from abroad. And that meant the current account could massively expand into deficit. So the current account deficit reached about 25% in 2007. So the banking system was essentially, this is the best way of looking at what was happening. The credit to the economy, this is 6-month moving average, credit to households and corporates increased very sharply between 2004 and 2008, and then goes on the downward path. The current account deficit, 6-month moving average from the balance of payments, follows it as mirror image. So essentially the banking sector was providing credit that the domestic economy was using to expand demand, and then it reflected in with a sort of 6-month lag in the current account. And of course, when the credit stopped, the current account turned to surplus very sharply. So it's the kind of the ebb and flow of credit that was crucial. And now here on the other side is the foreign liabilities of the banking system. So on the asset side, they're providing credit, and a few months later, they'll be borrowing from their parent banks in the Nordic countries and using it to basically finance this. So the economy was completely linked to external flows in a way that meant that basically none of the usual constraints of a small open economy with a fixed exchange rate held, because they could just borrow abroad. Now the only time this relationship doesn't hold is in the middle of 2009 during the crisis, when they reduced credit to the economy, when they started paying back foreign liabilities very sharply. Here is the same data, but in terms of credit, but now it's the impulse, so it's the change in the flow. And it's, if you like, the third derivative of the stock of credit. And this maps very nicely into real GDP. So essentially, the economy was driven in large part by this credit impulse, this third derivative of credit. And then when this turned negative, domestic demand fell sharply, as did real GDP. So you can see in year-on-year terms, real GDP fell about 16% through the middle to end of 2009. And again, it was because the Nordic banks were lending very with impunity almost, and then just suddenly cut back on the lending, and the economy went into freefall. So this was one of the worst, until Greece arrived, one of the worst crises that has faced any country in terms of the imprint on GDP since the Great Depression. I put on the HICP just to give a sense that that follows a similar pattern but with a lag. So prices eventually adjust, but there seems to be like an 18-month lag between credit and GDP. And here's the same kind of chart with unemployment and wages, nominal wages, but it's the same basic message. So very quickly, to run through how this plays out, when the crisis unfolded, it went in a number of stages, but to begin with, there was a program that was put together, and the key point here is that everybody in the IMF was worried that this was Argentina Mark II, and then there's the imprint of the Asia crisis, so no one really knew how to put together a program. And in any case, just before the IMF was called in, the Bank of Latvia cut reserve requirements twice. So essentially, they basically provided a lot of liquidity to the banking system. And so the IMF put together this program. One of the problems with the program was, look, because there was so much political pressure to go ahead with the program, they essentially produced a document that didn't really make sense. And the next stage after that was essentially that, so the program happened, put it together in December. In January, the currency starts to appreciate, everything looks pretty good. The EU approves some money, but then essentially there was a political crisis in February because the economy was in freefall. But one of the key points here as well is that net international reserves fell by 0.8 billion, which was related to one of the program conditions, which is essentially that, look, if NIR falls by more than 0.5 billion, then there's a consultation clause, we've got to reconsider whether to devalue, etc., etc. And that in itself then created a situation where staff had to try and deal with this. So they then encouraged the authorities to not let reserves fall, not allow NIR to fall by issuing debt. But then in June there was a failed debt auction, and the reason was pretty simple. There were outflows through the balance of payments, and excess liquidity had shrunk to nearly to zero, and there was no one to buy the debt. There's no liquidity left. And that provoked this sort of an op-ed from Rubini and all this panic about emerging markets. And so that created another mini crisis, and the EU ended up dispersing before the IMF did. So there was this kind of situation where, because nobody knew how to put together sort of the links between the balance of payments and the monetary accounts, the crisis was actually potentially worse than it ought to have been. So as a summary, this is sort of like what the program was like if you tried to go into details on what the different sector accounts were doing. Well, they didn't quite add up. And in terms of what actually happened, so this is if it's below zero, it's like providing net credit to the economy. So what was happening was the banks were lending to the economy, and then they pulled back on lending, so that the saving investment balance of the economy moved sharply from negative to positive in a very short period of time. So this is the actual private saving investment balance when the credit was withdrawn. And you can see this is the Baltics in general, this is percent of GDP. So Latvia's private saving investment balance, which is the current account plus the fiscal deficit, moved from, it moved 36% between 07 and 09, and GDP fell 21% over that period, and you have the same numbers for Lithuania and Estonia. So it was essentially the private sector that was being forced to save more because the credit had dried up. So the financial sector was basically driving all macroeconomic outcomes, and any expansionary fiscal policy that was there was pretty much irrelevant, because if the government was spending any money, it was flowing into money markets, but money markets were just withdrawing it and moving it away from the economy in order to speculate on a possible deval. So very quickly, I think the key point at the bottom here is that this is the decline in base money of the program, so that the authorities had reduced reserve requirements, and base money shrunk from, so base money fell from about 2.2 billion lats to about 1.6 billion over the first 6 months of the program. But when the liquidity ran out, because essentially it was a fixed exchange rate, they had to keep those reserves. That's when there was this debt auction problem, because there was no excess liquidity. And you had this situation where Rubini's writing in the FT that after this failed debt auction, the authorities are desperately trying to prevent a depreciation, and it's Argentina Mark II. But actually, to be fair, if it had been programmed properly, there wouldn't have been any need for these challenges. And you have here the interbank bid-ask spread on overnight lending in LATs from the period of the crisis, and there are two spikes here. One is in December 09, just as the program was negotiated, and the second one's in July 09. And in July 09, under pressure from the fact that the crisis was ongoing, the European Commission stepped in and they lent money to Latvians ahead of the IMF, without the IMF actually having done their analysis. Curiously enough, by the way, the affiliated Nordic banks, who were supposed to have keep most of the exposure to Latvia in place, they reduced a lot of exposure to Latvia over the first 6 months of the program. The blue lines is what the program expected, the blue dots on the right, and the blue bars are what actually happened. So they essentially used this excess reserves to speculate on the currency at a time when the crisis was beginning, because they were anticipating a devaluation because of this Argentina narrative.
Could you say again that sentence, if they'd done the programming properly, this wouldn't have happened?
Well, so the challenge is the following, that the program built in this idea that there's a 0.5 billion euros loss of net international reserves would trigger a side consultation on possible devaluation. The issue is that because the authorities had reduced reserve requirements twice, they created more than that amount of excess reserves anyway, and the government was going to buy back or redeem a T-bill that would create the same drain on international reserves, none of which were programmed, because the balance of payments was not visualized as a monetary phenomenon. It was visualized as exports, imports, and so forth, but you weren't looking at what were the internal drains. And given that the authorities had reduced reserve requirements twice in a fixed exchange rate with anticipation of devaluation, you basically got a flight on the currency. You get basically everyone ran for the hills because they were anticipating a devaluation. So, the targets that were set to the authorities didn't make any sense if the program had been constructed properly. So you ended up with a situation where the Nordic banks decided, look, we're going to get out. Who can blame them? And then...
just one further, in the expectation of depreciation, so is that what was wrong?
Yes.
What you said?
So because of the Argentina precedent, because essentially the idea was that, look, we don't want to lend to these guys on the currency board and to do another Argentina. The pressure was on, there was a lot of worry that that the IMF would end up making the same mistake. But they were under pressure from the Europeans. So the plan was basically, well, we don't have a choice here but to lend, but we'll try and distance ourselves from it. And so around that time, and I don't know why, but the Nordic banks were openly talking about the fact that the IMF wanted to devalue, whereas the Europeans didn't want them to. So there's this kind of tension between the different institutions. And so everybody kind of knew the open secret was the IMF don't want to be involved, but the political economy required the IMF to be involved. So that involved, instead of a sort of careful analysis, it involved sort of cutting corners and then hoping the blame could be passed on. So to give you a very solid example...
But you still haven't said, would careful analysis have somehow solved the problem?
Well, there were two issues. First of all, would the programme targets have been realistic? So would it be possible to set a set of programme targets that the authorities had a chance of meeting, that would not run them into problems in the middle of the year if the programme had been designed properly? Absolutely. To solve the problem of a current account adjustment like that is very difficult. So that's not going to be, it's not necessarily going to solve that problem, but it would help ameliorate it.
I don't understand that. Would it solve the problem or would it?
If the challenge is to minimise the loss of output, right? If the challenge is to reduce the variation of GDP, then it would have been possible to design a programme where the fiscal was much more expansionary, and where the programme's targets for the credit to the economy from the private sector banks were more realistic. So the Nordic banks were just able to stop lending and withdraw credit to the economy. The private sector had to adjust, and the current account had to move from -20 to +10. If we'd had a world where the Nordic banks had been forced to keep credit lines open more realistically, and the fiscal policy had been more expansive, then you could have offset some of that. So there were a number of ways it could have been done much better, which would have minimised the cost of the Latvian people, certainly. but the reality is,
Without devaluing.
well, or you could devalue as well. But we're just talking within the constraints of the currency board. You know, in any case, with a current account deficit of 20+%, it's going to be very difficult for it not to be painful, right? The only question is, how do you are we interested to try and minimise the cost, or are we going to try and create, additional problems along the way?
Thanks.
Anyway, the ex post assessment pointed out that there was delay, etc., and that the EU moved unilaterally to disperse. So this is all true. When this happened, and the question then becomes, well, would it have been better for the IMF to lead rather than follow in terms of regional financing arrangements? And the other thing is to note that there was the IMF's document at that time basically set out a number of different scenarios of adjustment. The two IMF scenarios were the red line and the blue line. The program scenario under the IMF scenario adjustment, and there's the EU adjustment, and then there's the actual outcomes in terms of public debt sustainability. So it was almost like a public relations exercise to put these projections out in case it went wrong, which is all very well, but again, it is not really asking the question, where are we and how can we improve the situation? So that's the actual outcome in terms of debt to GDP. The forecast error is pretty big, right? 8% of GDP, it's like 50%. But that was, again, it was the fact that there was so much institutional pressure to do the right thing. There was nobody actually, no one actually thinking through what was happening. And then the authorities, and you have to sympathise with them, I think, basically make the point that this review was eccentric, and the first review had these two scenarios, and there were very large forecast errors. This is very true. And the other point they make, which I think is really important, because the IMF should be in the business of re-engaging the private sector into financing, and they were worried that distancing from the authority strategy was not helpful in restoring market confidence. And I think that's true as well. I think this idea that we don't want to be involved and therefore we were kind of distancing ourselves made it more difficult for the authorities at that time. So that's the kind of situation where the programming is not done properly because of intellectual atrophy as well as political pressure. So then the question becomes, how does this play out in Greece? The story's different in Greece, of course, because the Greeks were facing their own challenges. I think the way to think about the Greece situation is, instead of looking at the banking sector that had borrowed so much in Latvia, the issue for the Greeks was the fact that their government debt had basically been bought up in large part by non-residents throughout the previous decades. So this is from their flow of funds data. This is the 4-quarter sum, and it shows so the black line is the fiscal balance, the red line is the financing as measured at market prices, the flow in the flow of funds. And you see the blue part here is the non-resident purchases of government debt. So throughout, from 1999 through 2009, 2010, the vast majority of government debt was bought by, and this includes the previous stock and new flow, the vast majority was bought by non-residents. And this was, of course, a period where they're joining the euro, everybody assumes that therefore there's no currency risk and there's no credit risk, etc. Interest rates were coming down sharply. And of course, once the crisis hits in 2010, you can see that non-residents were net sellers, and the green here is non-resident long-term loans, so it's basically official sector. But the key point here is that the non-resident share of government debt in Greece was actually, in the flow of funds, it's about 25% in 1998. By the time, just after it joined the euro, it was about 60%, and by the time the crisis hit, non-resident share was about 85% in terms of market prices. So the problem Greece had was not just an adjustment of their fiscal policy because of the stock of debt. They also had to generate the flows of finance, the flow of foreign exchange to return to the balance of payments issue to finance this external debt. There's a problem similar across the periphery in different ways, but it's worth recalling how the programme was put together and how it was impossible for Greece to meet the programme objective. So in May 2010, the programme's agreed. In early 2013, it's updated. I'll explain how in a minute. In late 2013, the economy collapses. Then they have debt relief, and then essentially what happened then was the Europeans committed to provide them with some debt relief. some official sector debt relief. The first one is private. And then they was reneged on. The Europeans refused to do what they said they would, and Prime Minister Samaras, quite understandably, went populist at that point, and then the next thing is Syriza and Varoufakis. So, in a way, the failings of Europe and the IMF meant that they brought on this extra challenge, which has kept the Greek economy stifled. So, what did the programme look like? So they needed 11.5% of GDP fiscal consolidation to begin with. Now this is all very well, but because of the fact that the fiscal and the balance of payments, or the current account, basically a mirror image of each other, the question is how's that going to play out? Because that's a reduction in domestic demand. How's the economy adjusting? Well, they assumed an external adjustment of 10 percentage points of GDP in terms of net exports. So exports of goods and services had to increase from 18% of GDP to 28% over the period of consolidation of 6 years. So that means exports, nominal exports, had to increase 65% in that period, while imports were only rising 5%. And this was all without the exchange rate channel, so without an expenditure switching channel. So essentially, you contract fiscal demand, and you would get external demand taking up the slack, almost one for one. That's the way that GDP was kept more or less constant, and that's the way debt sustainability was kind of justified. Alongside that, you had this external interest assumption as well, because the interest expenditure on the new loans, the interest cost was going to be higher than the maturing debt. So the actual interest expenditure was going to increase from 5% to 8% of GDP by 2015, but it wasn't reflected in the balance of payments. So again, how they're generating the foreign exchange to pay for this external debt. And the assumption was implicitly that 30 billion euros a year of foreign exchange was being generated, or 13% of GDP over the forecast horizon. So that brings to mind the German situation in the 1920s and 30s, where Keynes was concerned that the budgetary problem of extracting the sums of money out of the pockets of German people and the transfer problem of converting this money to foreign exchange are two distinct challenges. And he was worried that, that this transfer problem is people think it's of secondary importance, but so in other words, you solve the fiscal and the rest will solve itself. Of course, Keynes was aware that the economy is it's not a fluid, it's a very sticky thing, and you can't just move resources seamlessly between sectors. But this assumption was essentially that Greece would achieve this. On top of that, so by 2011, the economy was holding up okay, things were doing all right, but the Euro system had increased its exposure to the Greek economy. So basically, through the Target 2 system, the ECB had all this liquidity that had lent to Greece that was now a liability in the foreign liability side. So the Bank of Greece asked banks to devise and implement plans to reduce holding the debt to the ECB, and the IMF prepared this top-down forecast of the banking system to justify this return of liquidity. The problem is, again, how can they create the foreign exchange to repay the ECB through the balance of payments? And this was on top of the original assumptions. So implicitly, if you put together the two sets of assumptions, the private sector was being asked to find 30 plus 16, so about 45 billion per year of foreign exchange to repay the ECB and to sustain domestic demand and to keep the programme alive. Now, I think this is crucial in the narrative about Greece, because the assumption is that it was the Greeks' fault. But all of this relied on external demand, providing Greece with the exports to sustain the economy. And if that didn't happen, then the Greeks couldn't possibly repay. The programme couldn't possibly succeed. And in Paul Bluestein's recent book, he digs out a memo from the research department in 2010 saying, look, the research department memo says, look, we're concerned that even if the Greeks achieve all the objectives in terms of structural reforms, even if they can do that, we're still concerned that the programme cannot possibly succeed. So that's a bit like saying, look, it's impossible for this programme to succeed. But of course, the international community went ahead with it anyway, and the consequences for the Greeks have been dire. So what I think is interesting is if you look at the US data on the Freeman and Schwartz data on the left, and the Greek M3 data on the right, both of them are on the right scale, the blue lines. The chart on the right is exactly 5 times the scale of the one on the left. So in a way, they're comparable. At least they give you a sense of the sort of the scale of the increase in the M3 in Greece before the crisis, and in the US during the 1920s. And then you get a sense of the contraction in M3 in Greece relative to the US in the Great Depression. And you could argue that at this stage, at least the US was recovering. In Greece, they're still mired in this persistent indebtedness. And you can see it in the monetary accounts. They cannot generate the foreign exchange to lend to get the economy growing again. So this is just the same data. I'll skip that. But one more point to make as well is that this idea that the Greeks had this exposure to the euro system, that they had to repay it because the ECB didn't want this exposure, meant that in the middle of 2014, when Portugal, for example, they're very similar in size, these economies. So Portugal target 2 balances were actually above the Greeks. In fact, in percent of GDP, I think it's even higher. But when the Greeks received capital inflows back in 2013 and 14, they had to repay, the banking sector was on the lifeline, they had to repay the Europeans, so they couldn't get the economy moving again. And the credit that the economy could have created basically went back to Europe, and the economy was stuck mired in this depression. So I think the fact that and then basically when the Samaras went populist, and then you got Syriza coming back, capital flew out again, and you ended up with a higher target 2 balance to the euro system than they had before. But essentially the behaviour of the fact that the Greeks were forced not to use this money in any useful way means that they struggle. So I think that the euro area crisis can be viewed through the monetary accounts in particular. I showed earlier the credit impulse in Latvia. This is just the same impulse and the real growth rate of euro area in different countries. So you can see the initial crisis in 09-10, but then you see the second downturn in 2011-12 at the same time that there was a fiscal consolidation. The euro system, euro area as a whole, was contracting credit to the private sector when the government was contracting the fiscal. And the same pattern recurs in Spain, well, they're all subcomponents of the aggregate, of course, in Italy and Portugal. The ones it doesn't stand out as much on are Germany and France. But I think this idea that understanding the monetary accounts and the sort of structure of the economy and also the balance of payments is absolutely necessary to understand macroeconomic outcomes is crucial. So I was hoping to have an answer to the question, what does the euro area need to do to fix itself? I don't have an answer yet. But I think that the narrative that we have in the sort of academic areas and institutions steps back from these issues of balance of payments, monetary accounts, and the stickiness of the economy that Keynes foresaw in his transfer problem narrative. And instead we're ending up in this situation where solutions are incomplete or ill thought through. And I think we should be able to start bringing back some of this narrative in a way that we can actually address these crucial issues for Europe and for the global economy. So that's my 2 cents worth, if you have any questions.